Canada is sitting on the largest housing bubble of all time, according to a strategist. Does this mean that we're going to have this bubble burst sometime soon? I'm going to be breaking all of this down for you in this week's reaction video. Now, if you're looking for some help on how to navigate this real estate market, and you're afraid of headlines like this and not sure what to do with your portfolio or your home, you can book a call with me using the link that's on the screen right here. It's www.chatwithzen.com. Simply click on the date and a time that works best for you. And then when you see the prompt, fill in your name, email, mobile phone number, and the question you have for me, and then we'll chat then. Good day, Toronto. Welcome to another episode of Prime Properties TV. My name is Zhen, and I run and operate a RE/MAX in the Greater Toronto Area, on top of making awesome educational real estate content just like this one for you. And if you're enjoying the content so far and you're getting knowledge out of this and it's helping you on your real estate journey, help me spread the knowledge by smashing the like button and subscribing to the Prime Properties channel. Now, the only article we'll be reviewing today is from BNN Bloomberg. Canada likely sitting on the largest housing bubble of all time. Dun, dun, dun. I'm going to cut to the little snippet of him talking about this because this article doesn't have too much, so you can check it out right now.
If somebody has a house in an inflated city in Canada, you would suggest they think about selling it anyway.
Yeah, I mean, the problem with Canadian housing is it really got ramped up over, really, it's been 2 decades in the making, right? We had low inflation driven in the 2000s, for example, because of the commodity boom, drove up currencies and pushed down import prices. So it allowed the Bank of Canada to be more accommodative than it should have been. Then in the 2010s, after the housing bear markets in the US and Euro area, we had the global price setters dampening inflation. We had Bank of Canada playing competitive currency devaluation. So we ended up with, again, too easy accommodations, pushed up home prices. And the pandemic hits, and there's a case for it to burst. But we hit it again with monetary and fiscal policy, and so we inflated again. So you've had 2 decades in the making. You've got home prices that are very stretched. The worst part for a housing bubble is when you have a credit bubble underneath it. And the amount of Canadian leverage into the system versus incomes is pretty astronomical. And we've seen debt servicing going up dramatically. We've seen it's very hard. A lot of homeowners, they don't benefit from 30-year fix like the United States does.
Yeah.
So there was a lot of floating that got reset. There's a lot of other that are rolling over within 5 years. And we've been in a couple of years of this higher interest rate environment. So we have some risks in the situation. We see the Canadian banks really not wanting to allow it to topple. They've been trying to extend these things. But that's, in many ways, at some point it will. We've got Wild E. Coyote sitting over a cliff, and the bank's trying to hold the plank out to hold it up, but not to be too scary. But there is a risk, definitely a risk here, that if mortgage rates go higher or unemployment were to rise when we hit the next recession, then this thing does end up in a deleveraging cycle. Philip.
So when I watched that video, the few things that jumped out to me are this, right? He's calling that we have a credit bubble underneath the housing bubble. So housing bubble meaning the prices are too high relative to affordability. I've talked about that before. And then the credit bubble underneath is that the Canadians have too much debt relative to the level of income that they have, right? So this is a chart that I took from CBC to show you guys what's going on. And you can see over here in this red line, this is the debt to income. So at 150, it means that for every dollar that a Canadian has, they spend 150, or sorry, not 150, $1.50. That'd be really bad. So they spend 50% more than what they earn. And this is all into kind of the idea of the mortgage, right? Because mortgage is considered debt. And there's a lot of talk about how Canadians basically use the house as kind of like an ATM, right? Every time they want to buy or finance something, they just refinance the housing prices because in the last 20 years, prices have gone up quite a lot, right? And you can see in the blue line, this is 2008 when basically US had their housing crisis and it kind of corrected from there. So then a lot of people have deleveraged and now they're actually back at 100%. So Canada, along with Australia, New Zealand are some of the highest debt to incomes around the world, right? Again, also G7 countries. So is this one of the reasons that prices are going to come down and we're going to crash from this kind of bubble, like the greatest bubble of all time? Yeah, I mean, this has always been argued, right? I don't disagree with them. It's just that it always seems to kind of get propagated over and over again, right? So in the article, he talks about the 3 things that kept propping up the real estate market, right? So monetary policy. Monetary policy being kind of what the government has done. So the first one he talks about in 2008 is basically it kind of ran up. Kind of, if you go back to the chart over here, we can see that very similar. US, Canada went side by side. Then he talks about how in 2008, basically US had that giant crisis and then prices came down. The debt to income also came down. In Canada, we only felt it for like 6 months or so. It was like very slow for a little bit, like 74,000 sales relative to what the normal is, about like 100, right, in the next few years. But Canada can continue riding its wave, right? So, and then as the US drop their interest rates, Canada generally tries to match US, right? Because we're the biggest trading partner. We are US's hat, right? So because US dropped their rates to basically stimulate kind of the economy, Canada dropped their rate too. And then now that provided another leg up for the real estate market in Canada because we didn't have that kind of correction. And then obviously the third one being the pandemic, where it stimulated again. So his argument is that the government, right, federal government or banking, whatever you want to call it, the government has been propagating the prices of real estate for a very long time. And the question now becomes is, are the banks going to keep pushing this kind of down the line, right? Because we've always talked about negative amortization. That becomes a risk. I don't think it's a huge risk because people are going to have the chance to sell off. But if people are going to wait too long, if they know they have to sell off, then that could be problematic for, the real estate market. So the question is, are the banks and kind of the government going to work together to kind of prolong this quote unquote bubble, right? Again, a bubble doesn't have to burst. It could deflate. It could slowly grind down. There's a lot of ways that can happen to it, right? So when we talk about, are the banks going to propagate this a little bit more, we're talking about the negative amortization. Because I would personally say that if we weren't negative amortizing, I would think we would see a lot more listings and there'd be a steeper drop in price, right? But at the moment right now, we have negative amortizations that go up until like 2026. So come 2025, 2026, when a lot of these renew and they don't have enough time, are the banks going to basically do something with the government to prevent the prices from coming down, right? Are we going to extend amortizations, right? Are we going to only allow those people who have it renew to like 40 years so it prevents the prices from down? We don't know, right? But if I look at the incentive structure, right, like the governments that are in power, do they want, like a housing crisis? No. Do the banks want a housing crisis because they're collateral, right? Because let's say you do 20% down, the bank basically has that at 80%. So if the prices drop below 20%, there's a very good chance the banks won't even get their money back, right? So they're going to have a lot of loan losses, right? So it's not in neither one of their incentives to have prices fall. So can I see them propagate it? Maybe, I don't know. But like the guy was saying, there's been kind of 3 times history in the pack of the government's kind of propagating the real estate market, right? And then this is all before all the immigration and the housing shortage, right? Just strictly talking about monetary policy. Now, the other thing that I'll point out is that he's talking about there's definitely a risk that there'll be mortgage rates go higher, or unemployment were to rise, that we hit a recession. And this is a thing that can start the deleveraging cycle. Meaning if mortgage rates continue to go higher, I think we're kind of at the peak, right? We may have another rate hike in September or like in the fall, one more, but the market seems to think that's it. More about that later on this week on Thursday. Or the risk of unemployment increases, right? So as we head into a recession. So that could start and be kind of like, call it the little fire that starts this giant housing crisis, giant bubble that's going to burst, right? So when we kind of look at data for if we're going to have recession, so this is the OECD composite leading indicator. And every time that it's dipped to very low points, kind of below here, you can see that it did a very good job predicting a recession. So right now in 2020, when we had to call it pandemic recession, it did come down. And now we are right here, just on the cusp. So I've been talking a lot, like there's a lot of indicators pointing to recession that it's going to happen at some point. And we're actually slowly starting to see unemployment go up as well. So when we go into this recession, is it going to be a soft landing, meaning like, it's going to be a very moderate one, or is it going to be really, really hard where a lot of people go through financial hardship? But we are most definitely seeing signs of kind of the economy softening right now. Now, the other thing to point out to you is that the 3-month change in unemployment rate. You can basically see that no one was getting unemployment because during the pandemic, CERB money was being handed out. You can see right now we are just starting to cusp up. So this on the left axis is a 50 basis points increase. So that means that we went up 0.5% of unemployment rate. So it's not a huge amount, but we're going in that other direction right now. So we could very much be in a recession right now and won't find out later, but how severe of a recession, we just don't know at the moment right now, right? So here's some other interesting data that I pulled. So this is a chart showing you mortgage delinquencies at B lenders, right? So HCG is Home Capital Group. So you can see that right now in 2022, delinquencies are very, very low, and it's slowly starting to creep up, right? So when you look at the chart, again, the chart doesn't look great, but you have to look at kind of the axis, right? So right now it's at 0.4%. So that means 1 in 200-ish mortgages roughly are kind of impaired right now. So it's not that big of a kind of scale when you kind of look at it, but it is increasing, right? So this is a B lenders. If we're going to see some kind of weakness, we're going to see it in the B lenders first, and it trickles into the A lenders, right? Because the A lenders are still allowing them to negative amortize. And this is the same thing when you look at Equitable Bank, right? So EQB, so you can see has gone up to about 0.25. So this is 1 in 400 mortgages. Keep in mind, the mortgage delinquency rate in Ontario is like 0.17. So that's like 1 in like 600 something mortgages that are delinquent. So there's still a long ways to go before we see a lot of these mortgages collapse. But the key thing is the unemployment, right? Because if employment is very, very strong, then people will find a way, gig economy is working a second time, like a second job to basically support the mortgages, because a lot of people don't want to lose their home. But if we see unemployment tick up while the rates stay high, then that's probably where we're going to see a little bit of issue with some of these kind of like delinquencies, and maybe some of them will be coming on to sale in the market much sooner than most people think, right? And that's kind of what everyone's watching for, right? Like, how bad is this looming recession that's coming? And is this looming recession going to cause the Canadian biggest housing bubble of all time to burst? We're going to find out. Now, if you are concerned about all of this and what to do with your own personal home or your portfolio, and you want to kind of discuss about what options you have, you can book a call with me. So the link that's right here. It's www.chatwithzen.com. Until next time, your move, your future. See ya. Now that I'm done watching this video, I think you should check out this video. And you know what? Why don't you check out this video too?